So how do you buy and sell stock? Well, to buy or sell a stock, you usually have to go through a broker. Some brokers, usually called full-service brokers, provide a range of services beyond filling buy and sell orders, like researching investments and helping you develop long and short-term investment goals. Then there's discount brokers, or supermarkets. They carry out transactions for clients at lower fees than full-service brokers, but generally have more limited services. For experienced investors who trade often and in large blocks of stock, there are deep discount brokers whose commissions are even lower. Online trading is the cheapest way to trade stocks, E-Trade, Scottrade, companies like that. Online brokerage firms offer substantial discounts while giving you fast access to accounts through their website. You can research stocks, track investments, follow market developments. Some online firms even enable you to trade before and after normal hours, trading hours. Most of today's leading full-service and discount brokerage firms make online trading also available to their customers. It's generally extremely cost-effective for independent investors with a solid strategy who are willing to take a lot of time to undertake their own research. So the ease of making trades in the absence of advice may tempt some investors to trade in and out of stocks too quickly and magnify the possibility of locking in short-term losses. You also might be able to buy stock directly from the company that issues it through a dividend reinvestment plan, or by contacting a company. Disney is an example. If you sign up, you can make additional cash purchases as well. A number of large companies offer these plans and charge only a minimal fee, $10 or $15, to handle a transaction. It may take more time to sell the stocks that are held in a company account than it does to sell shares that are held in a brokerage account, though. Selling short is the sale of a security that you don't own. It's heavily regulated, and at a point in time in the future, you have to cover the purchase. You have to buy the stock that you sold that you don't own. Ideally, at the point when the short sale is purchased, the price of the company will be lower than it is at the time when it's sold. So that generates a profit for you, the investor. Short sales are done at brokerage firms by utilizing a margin account. The brokerage firm lends the money, basically lends the stock to the customer. So it's a form of leverage. Short sellers are pessimists. They expect prices to go down. To profit from, as a short seller, you borrow shares of stock from the broker, sell it short, pocket the money you gain from the sale if the price goes down as you calculated it would. The strategy obviously can backfire, because if the stock price goes up rather than down or even stable for an extended period, interest charges mount, and you may decide to cover your short position by buying at a higher price, or you may have to cover it by buying at a higher price than you paid when you sold them, or than you got when you sold them. That'll leave you with a loss. And if the price continues to rise, your costs and potential losses will mount. So there are a lot of risks of investing in stock. Investors buy a stock when they think it's a good investment. Demand drives the stock price up. But if people think a company's outlook is poor and either don't invest or sell shares they already own, the stock price will fall. Investor expectations determine the price of stock. Supply and demand, as we've been discussing all along. If a lot of investors buy stock A, its price will be driven up. The stock will become more valuable because there's demand for it. But the reverse is also true. If a lot of investors sell stock Z, its price will plummet. The further the stock price falls, the more investors sell it, driving the price down even more. Both issues become self-fulfilling prophecies. Investor enthusiasm for a stock can sometimes take momentum on its own, driving prices up independent of the company's actual financial outlook. A number of years ago, companies like Yahoo and Google were outrageously driven up in price with no earnings, with zero earnings. But many investors disregard market trends and base their expectations of a company's sales and earnings on quantifiable evidence of their strength and their future potential. When a company's earnings are up, confidence increases, the price of the stock usually rises. If the company's losing money or not making as much as anticipated, the stock price usually falls. Rising stock prices and regular dividends that reward investors and give them confidence are tied directly to the financial health of the company. There have always been speculative bubbles, periods when stock prices have risen to unsustainable levels on investor optimism. The late 90s, the bull markets of 1970 to 1972, 1982 to 1987, 2008. Usually a period of very high stock prices is followed by a period of depressed prices, like 2009 and 10. That's the time to buy. Stocks become undervalued. They fall lower in price than a company's prospect would seem to warrant, and investors overreact to negative news, however, like a company's profit warning, rising interest rates, or economic or political upheaval at home or abroad. And most investors bail out at exactly the wrong time, at exactly the time when they should be buying in. How do you evaluate stocks? It's pretty complicated. There are a wide range of rating systems and indices to represent various components of the market. Most financial service firms, especially brokerage houses, rate stocks that they fall independently of one another. The most common rating system divides securities into buy, sell, or hold categories, or some variation thereof. But as with any way of characterizing any security, you need to be careful of what the actual definition of what it means. What does a buy stock mean? What does a sell stock mean? And do they ever, sell the stocks that are triggered as hold? So we'll talk more about this in later sessions.